And now we'll discuss SA 570 going concern. And now we'll see some callouts here. Under the going concern basis of accounting, the financial statements are prepared on the assumption that the entity is going concern and will continue its operation for a foreseeable future. That when audit accounting of the financial statement was prepared as per going concern basis, then what they'll have be classified as a current liability, non-current liability, etc. If it was not prepared under a going concern concept, all the maturities, all the loans would come to the maturity and all. That's how the financial statements were prepared. This is the all clear cut of how the financial statements would have been. So, for a foreseeable future, means foreseeable future is the next audit term. That if it's 3 months, 3 months, 12 months, 12 months, that's a foreseeable future. General purpose financial statements are prepared using going concern basis unless the management either intends to liquidate the entity or cease operations or have no realistic alternative but to do so. This is the key phrase. This phrase, these three lines you have to write whenever you find any going concern concept. You see, these summary, these callouts are something that you have to remember, okay, and write it in your examination. That's why it was given in a special place. Okay, so this is with regards to that. And if the financial reporting framework contains an explicit requirement, the financial reporting framework contains an explicit requirement or not for the management to make specific assessment for the entity's ability to continue, it's management responsibility to assess the entity's ability to to continue as a going concern or not. You see, like this, we have seen somewhere with regards to the related parties, right? If the AFRF explicitly recommends or not, the auditor has to identify the related party transactions and related relationships. Likewise, if even if the FRF explicitly provides a recommendation for the going concern or not, the management should assess the going concern concept. And coming to the objectives of the auditor are to obtain sufficient appropriate audit evidence regarding the appropriateness of the management use of going concern basis accounting. He has to check whether the going concern assumption is appropriate or not, and to conclude, okay, he has to conclude something. What he has to do based on the audit evidence obtained, whether a material uncertainty exists or not, which cast a significant doubt on entity's ability to continue as a going concern and report it as per SC. What he has to do, he has to uh, show whether he has to obtain sufficient appropriate audit evidence that going concern is appropriate or not. Second thing, he has to conclude whether exists a material uncertainty related to the events or not. That is, an event had occurred which would cast a significant doubt on the going concern. So uncertainty is like the event had occurred that this going concern will not be applicable. Okay, it's a negative kind of word. And there were few indications with regards to the going concern assumption. What all these indicators, you could read it, that or you can take a printout of it, and it was available in the telegram. You could read it. It just what does it do is something that was anything that was of negative to the financial statements will go with like a net liability or net current liabilities position. That is a negative mark there, negative position in the financial statements or inability to pay the creditors. It was all the negative sides of it. For the operating indications like labor difficulties or loss of key management, and they have without replacement and all, and an emergence of highly successful competitors there. So those were like indicators which would cast a doubt on the going concern basis of the entity. Other indicators like non-compliances and pending legal proceedings, etc. You could just read it. And with that said, we'll just dive into the standard SF570. Yes. What are the factors that relevant to the management assessment of the entity's ability to continue as a going concern? You see, what the auditor has to do, auditor has to obtain sufficient appropriate audit evidence that going concern concept is appropriate or not. What factors he has to check? He has to check the degree of uncertainty, whether it is material or immaterial, whether that event is material, that it would affect the going concern assumption or not. He has to check that. He has to check the size and complexity of the entity, whether, as we have said, for the operating indicators like a successful competitor, and with regards to the other indicators like what legal proceedings, etc., penalties and all. With regards to the complexity of those transactions and the size of the entity, with regards to the competitor and all, we have to check that. And any judgment about the future is based on the information available at the time at which judgment is made. That is with regards to the judgment of the any kind of information in which time it has taken, whether it has taken at the time when the laws have not fully been amended or when the new competitor hadn't come, likewise. And those are the factors with regards to that. And management, preliminary assessment of entity's ability to continue as a going concern. In our call out, what we have seen, whether FRF explicitly required to check the going concern assumption or not, management has to do that, right? How the management has to do. If such assessment had been performed, what that has to do. The auditor shall discuss with the management on the identified events that cast a doubt on entity's ability to continue as a going concern. The management had done that assessment. Auditor, what he'll do, he will take the events or the conditions that cast a doubt on going concern. If the assessment had not yet been performed, he has to ask, okay, if you are not have done that, on what basis you are preparing the financial statements on a going concern basis, which would or whether the events that may cast, and inquire for the events that cast a doubt on the financial statement of or cast it out on the going concern concept. First thing, when they have done, he will take the identify the events or conditions that were identified by the management. If have not done, on what basis they have done, and inquire the events, etc. And the auditor shall remain alert throughout the audit for the audit evidence for the events that cast a significant doubt. This is like professional skepticism. Even for the related party transactions, he has to maintain a professional skepticism throughout the audit with regards to the related party transactions, and for the events and conditions that cast a doubt on the going concern also, he has to remain alert throughout the audit. And the audit procedures, when events and conditions are identified, what he has to do, what's objective of the auditor? Objective of the auditor is to identify the events and conditions that cast a significant doubt on the going concern. Then what the auditor has to do when he found those events? When management not performed assessment, request management to make assessment. Okay, management has to do as per FRF. If I had not done, what he has to do? He has to request management to make assessment and evaluate management plans for the future actions for going concern assessment. And when entity has prepared cash flow forecast, evaluate the reliability of the data and consider whether any additional facts information available, and request written representation from management and TCWG regarding future plans and feasibility. You see, all the audit procedures regards to the only the future plans, everything with regards to the future. This assessment, except this assessment, this one you could anyways write. And for this, the future action plans, and second thing, all the cash flow forecast and the reliability of the data, and any other reliability additional information that was available, and ask the future plans with written representation. And what's the second objective of the auditor? Second objective of the auditor is to conclude. There were four types of conclusions that the auditor may reach. First one is adequacy of disclosures when events or conditions have been identified and the material uncertainty exists. What is his objectives? Two things: to identify the events and the conditions, events or conditions that were identified that cast a doubt on going concern, and whether there were uncertain, the degree of the uncertainty, right? When that degree is material, then what he has to do? The management's plans to deal with these events and conditions and disclose clearly that there is a material uncertainty. For the 2 points, he has to do. When events were identified, he has to write what? He has to report the management plans how to deal with events or conditions. When he got this, he got like this when he found the where are they and management plans for the future actions for the going concern concept and their future actions. He has to report here and clearly disclose there are material uncertainty exists. That's first one. And when adequacy of disclosures if events have been identified, but no material uncertainty. That is, this uncertainty is not material. Then what he has to do? He has to just evaluate the requirements of AFRF with regards to the adequacy of the disclosures of the events and conditions. Only the first point has to be written. Only for the first point has to be written. Since it is material, he has to report the future plans of the management and disclose the material uncertainty. When there were no material uncertainty, no need of future plans, what he has to do? He has to do report only as per AFRF. You have to evaluate the requirements as per AFRF. Okay, we have done with two. And the third one is the use of going concern accounting is appropriate, but there exists a material uncertainty. You see, going concern is appropriate, but there were few conditions or events that would cast the uncertainty would be material. So it's plus one condition and minus one condition. Then what the auditor has to do for the first thing, for the events and all, he has to give some adequate disclosures because the going concern is adequate. He has to express an unmodified opinion, that is a clean report, and auditor shall report there exists an uncertainty, material uncertainty for the things. When there exists a material uncertainty, he has to disclose clearly that there exists a material uncertainty. Okay, and when there were events identified that casted out on going concern, he has to report the management plans. When the going concern is good, fine, he has to issue an unmodified opinion. If adequate disclosures for the material uncertainty but it's not made in the financial statements, then what he has to do? He has to qualify the opinion or an adverse opinion or give an adverse opinion. In the basis of qualified opinion, he may state that there exists some material uncertainty. Whenever there's a material uncertainty, he has to disclose that. And the fourth one is the use of going concern is inappropriate. What the auditor has to do, he has to issue an adverse opinion. And that's it. We have completed our going concern essay 570 also.